What's up guys, in today's video we're going to be talking about the two different investment strategies, lump sum investing versus that of dollar cost averaging. I've had a couple of comments from you guys asking which is the better strategy, so in this video I'm going to try and explain which strategy will actually put more money in your back pocket. Well, I'll talk through some of the key considerations that you're probably going to want to make before looking to engage in either one of these strategies, along with we'll dive into which strategy is statistically the best one based on some of the previous research studies in which have been completed. But before I do so guys, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, hit that big red subscribe button down below as well. Drop a like on the video guys, really helps out the channel. With that being said, let's dive straight into it. But firstly, let's strip things back to basics by explaining what lump sum investing is versus that of cost averaging into the market, or if you're an American, you're probably more familiar with the term dollar cost averaging. Well, lump sum investing is typically what it says on the tin. Let's say you've inherited some money, you've got a bonus from work, you've sold a business, or even if you're retired, or if you're very lucky, perhaps even won the lottery. In this instance, it's important to get that money working for you in the best way possible. Therefore, you could use this money as a lump sum investment in the stock market, whereby essentially you invest all of your available funds into the stock market all at the same time. But let's say on the other hand, you don't have a big chunk of cash available to you, but instead you possibly have a few £100s in disposable income every single month that you could look to afford to invest in the market. Or perhaps as an alternative, perhaps you do have a big chunk of cash available, but you don't want to invest it all into the stock market all at the same time. Due to this, you could do something called cost averaging your way into the market. This is whereby you start investing during regular intervals, whether that's monthly, quarterly, or even on an annual basis. So in essence, you've got two different approaches here. You can throw all of your money in at once, or you could invest that money over time. So let's talk about these strategies in action using a specific example in which I've just prepared for this video. We'll also dive into some key considerations as well as the benefits and drawbacks of both. So let's bring this to life somewhat and talk about the two approaches by having a hypothetical example of whereby you have £10,000 in funds available that you can invest into the stock market. And let's also turn back time 5 years, back to 2016, to give us kind of a 5-year time span in which we can work some calculations from. So on April 1st, 2016, let's say we lump sum invest £10,000 into Apple stock. Now at that point in time, we could have bought one share in Apple for just $27.50. And back then, the exchange rate between the Great British Pound and the United States dollar was 1.41. So therefore, for every pound in which you converted into United States dollars, you'd get $1.41. Now without overcomplicating things, because there's a ton of variables at play when obviously you're investing, let's just assume that there's no other FX rate fees associated, along with no other transaction fees for actually making this investment. If we convert that £10,000 into dollars, we'd have $14,100 to play with, which means with a stock price of $27.50, we could actually accumulate 509 shares in Apple stock and have roughly $2.50 spare for a cup of coffee at the end of it. Now, as of the current market prices of just over $121 per share, those 509 shares, or the $14,100 initial investment, would have provided you with a net return of 340.76%, which means that initial lump sum investment in which you will have made would now be worth $63,037. And calculating for an exchange rate difference today of $1.38, we would convert that back into Great British Pounds to the value of £45,679. Now I'm sure as an investor you'd be pretty satisfied with those rates of return over the course of the past 5 years. But let's say back in 2016 you didn't have £10,000 in cash available. Or perhaps you did, but you just didn't want to invest it all at the same time. Well, let's assume that we had that £10,000 available, but instead we wanted to cost average our way into the market instead. So to do this, we invested £2,000 per year into Apple stock from 2016 up until 2020. Now, just so I don't bore you guys with all of the calculations and all of the details, let me flash them up on screen, because there are a couple of key critical observations to make. The first one being the total amount invested was just $13,180. That's because of unfavorable exchange rate differences, which meant that the Great British Pound was actually predominantly weaker during that 5-year period. This therefore compares to the lump sum investment which was made in the first hypothetical example of $14,100. The second key consideration is that the average purchase price is $43 per share, and due to this we were only able to accumulate 333 shares in Apple. This obviously compares to the average purchase price of $27.50 in the the lump sum investment scenario and the 509 shares in which we accumulated. Due to all of this, it had obviously a big impact on the overall net return on investment, with cost averaging only warranting a net return of 181.8% versus that of lump sum investing of 340%. Due to this, from cost averaging, you ended up with $37,141, or the equivalent to £26,913. This compares to that of the nearly £46,000 in which we would have had if we lump sum invested instead. So based on all of those assumptions, based on that specific stock during that specific time frame with the specific exchange rate differences, and assuming that there's no other fees or charges involved, as well as discounting for dividends, it's clear to obviously see that lump sum investing would have been the better strategy from a monetary and a return on investment point of view. But that's not always the case, because over a 24-month spell, I managed to find a little bit of research that was done comparing these two strategies. And from these research studies, we can see that dollar cost averaging can sometimes outperform lump sum investing. So where we are above the horizontal line, dollar cost averaging actually performed the best, but where we were below the line, dollar cost averaging actually underperformed that against lump sum investing. And the differences of the two can be quite substantial during this time period. Sometimes dollar cost averaging can be as good as offering an additional 25% upside, but then on occasion can lose out on some 50% gains if investing during the wrong conditions. But I think as a summary, you can really see that lump sum investing does outperform dollar cost averaging more times than not. And therefore, this kind of concludes that lump sum investing is the best investment strategy from a return on investment point of view. But that is not the full story here, because there are lots of other factors and considerations that you're certainly going to want to take a note of. The first one being the future is unknown. Nobody knows whether the market is going to move up, down, or sideways next week, next month, or even over the course of the next 5 years. Due to this, you do certainly have to be comfortable with the unknown when you're lump sum investing. The stock market could just as easily drop 20, 30, or 40%, just as easily as it could gain 20, 30, or 40%. Therefore, if you're thinking about putting a big chunk of your cash into the stock market all at one specific time, just be prepared for the worst and what that could potentially look like for your investment portfolio. The second key consideration is the psychological challenges. And I think this kind of links into the above, because let's say you've invested a big chunk of cash at one specific point in time, and then after that point in time, the market has fairly unfavorable conditions and overall is performing very poorly on the whole. That could be a huge psychological challenge, especially if you're new to stock market investing. Seeing your overall portfolio value, along with what could be potentially a lot of your net worth and potentially a lifetime of savings in which you've invested into the market, decline in value quite significantly, could be something that could potentially keep you awake at night. So it's probably wise to know your own personal psychological tolerance and what that will look like if you potentially see some big short-term losses in your investment portfolio. The third key consideration is to have a plan. One saying that's always stuck with me is that proper planning prevents piss poor performance. If you're thinking about investing any kind of money into the stock market, it's always wise to have a plan. Know exactly what you want to invest in and why. Know how much you want to invest in and why. Know the historical price performance and future forecasts of the asset in which you're looking to buy. Know the exact investment time horizon that you're looking at and why, along with considering what your overall exit strategy will look like. There are a lot of things that you're going to want to consider when you're looking to invest into the stock market. It's something that you certainly don't want to go in blind, so because of that, have a plan, even if it's just a mental plan that you have in your mind, on how you foresee that this will all play out for you. Because not having an objective plan in place beforehand can certainly lead to some irrational decisions being made, especially when the market is not going in your favor. Now, the above may certainly challenge some of your mindset and beliefs about what the better strategy is around lump sum investing versus that of cost averaging. But let me also throw this in, because lump sum investing obviously does perform better from a return on investment point of view, but it doesn't necessarily mean that you'll end up with more money over the course of the long term. So let's talk about the two different approaches, but from the angle of compounded growth. Being those two examples are a £10,000 lump sum into the market versus that of a £250 per month investment over the course of 10 years. Assuming a 10% annual rate of return, the lump sum investor would turn his £10,000 into £27,000. But the investor who was cost averaging into the market over the course of that same 10-year period would have turned that initial £250 with £250 every month from there onwards into £52,000. Now yes, obviously cost averaging your way into the market, you would have put a lot more money into the market over the course of that 10-year period. In actual fact, £30,000 of that £52,000 in which you have would have been the investment in which you would have made. But by cost averaging your way into the market, you actually have more money overall. And because your investment portfolio is comparably bigger from a monetary point of view, that portfolio will also compound quicker over the course of the long term as well. Now, there are certainly a ton of different variables to consider, and personal circumstances and overall risk tolerance will largely drive your investing decisions and the overall investment strategy in which you use. For me personally, I use the cost averaging approach to investing, largely because I don't have big chunks of cash lying around that I can look to lump sum invest into the market. But don't let that discourage you from taking a little bit of a hybrid approach to your investment strategy, because not only can you cost average your way into the market, let's say you get a bonus from work or you come into some extra cash somehow, or even if you've just saved a little bit of money over time that you want to invest into the stock market, you can always look to lump sum an amount of money when you see opportunities in the market to do so. So be sure to let me know, guys, what strategy you use down in the comment section below. If you enjoyed the video as well, guys, be sure to drop a like on it, subscribe to the channel if you're new around here, and with that being said, I'll see you over in the next video.